We are covering the critical rules for prior year refund applications, specifically the statute of limitations for claiming a refund. The exam will test you heavily on the lookback periods. The general rule is that a claim for refund must be filed within 3 years from the date the return was filed, or 2 years from the date the tax was paid, whichever is later. For a timely filed return, this effectively creates a 3-year look-back period from the original due date. For example, if a taxpayer filed their 2023 return on April 15, 2024, they have until April 15, 2027 to amend it and claim a refund. A classic exam trap involves extensions. If that same taxpayer filed an extension and submitted their return on October 15, 2024, the 3-year clock still starts from the original due date, April 15, 2024. The extension to file is not an extension to the statute of limitations for a refund. Do not confuse these two timelines. Now let's discuss the exceptions, because the exam loves exceptions. The most important special rule relates to bad debts and worthless securities. Instead of 3 years, the look-back period is extended to 7 years from the due date of the return for the year the debt became worthless or the security was discovered to be worthless. The exam might present a scenario where a taxpayer bought stock in 2020 and the company declared bankruptcy in 2023, making the stock worthless. The taxpayer has 7 years from the due date of their 2023 return to claim that loss. Here's a simple way to remember it. Just think, bad worthless stocks, 7 years. This helps separate it from the standard 3-year rule. The exam also tests the concepts of protective and informal claims. A protective claim is a formal claim filed to preserve the right to a refund when the taxpayer's right to that refund is contingent on a future event, like a pending lawsuit or an ongoing audit. It's filed on Form 843 or an amended return with a clear statement that it's a protective claim. An informal claim, on the other hand, isn't on a specific form. It could be a letter to the IRS that indicates a basis for a refund. While not ideal, it can be perfected into a formal claim later and still be considered timely filed as of the date of the informal claim. The key distinction for the exam is that a protective claim is for a contingency that has not yet occurred, while an informal claim usually relates to a current issue communicated improperly. Finally, there's a provision for financial disability. If a taxpayer is medically determined to be unable to manage their financial affairs due to a physical or mental impairment, the statute of limitations can be suspended for the period of disability. The exam will require you to know that this doesn't stop the clock indefinitely, only for the time the taxpayer was medically proven to be impaired and unable to act. This is a narrow exception and requires specific proof, but it is a testable concept that can override the standard 3-year and 7-year deadlines. Understanding these nuances is key to correctly answering questions on refund statutes.